In this chapter, we will talk about accounting for receivables. We will talk first about accounts receivable and then about notes receivable. We will learn how to recognize accounts receivable and the methods that companies they use in order to evaluate or get to the value of the receivables that they will collect. And then we will also learn how to write the journal entries for disposing of receivables. We will also talk about notes receivables, and at the end we will explain how they are presented on the financial statements. First, there are three main categories of receivables. There are accounts receivables, and this is basically the money that customers owe to the company. Once, for example, when the company conducts business on account, for example, if they provide services on account or they make sales on account. This is called accounts receivable. Another kind of receivable is notes receivable. This has a stronger claim against the assets of the customer because they have a formal promissory note where the borrower of the money has officially promised to pay back on a certain date, and most of the time this kind of instruments also incur interest depending on the agreement. And because there's a proof of the debt, company like basically notes receivable, they have a stronger claim on assets than accounts receivable. And there's also the non-trade receivables, like for example tax, like returns from tax, from income tax. So we have also interest receivable. We have the money that employees might owe the company and they would have to pay it back to them, like for example advances to employees, etc. All these are called non-trade receivables or other receivables, and we call them non-trade because they are not generated by companies' business. Now, this slide here simply shows how important this kind of assets is, because a lot of companies conduct business on account, and as a result, it's very often one of the largest assets, and it's very liquid because it can companies they usually expect to turn for example accounts receivable pretty fast into cash. For instance, we can see here that General Electric has over 50% of their total assets is receivables. Now, there are three main issues that are associated with accounts receivable. Here we will start with accounts receivable. So there are three main issues associated with accounts receivable that we need to take into consideration, and those are recognizing the account receivable, valuing them, and disposing of them. So recognizing them is like we have studied so far. When the company provides a service on account, the company would debit accounts receivable and credit service revenue. And when the company makes a sale on account, a merchandiser company would record the accounts receivable by debiting accounts receivable and crediting sales revenue. And usually the company would do that and this is done when the service is provided. According to GAAP, this service or companies would recognize account receivable when the service is provided, and merchandisers, they would recognize the account receivable when the sale is made. So for example, assume that DoorDash company on July 1st, 2014 sells merchandise on account to Polo company for $1,000, terms 210 net 30. Prepare the journal entry to record this transaction on the books of DoorDash company. So on July 1st, the company has made the sale. As a result, they have made the sale for $1,000. on account because it says here that the terms are here. Terms are 210 net 30, which is to mean this is on account. As a result, the company would debit accounts receivable $1,000 and they would credit sales revenue $1,000. On July 5th, Polo returns merchandise worth $100 to Jordache Company. In this case, the company will be the customer has returned sold merchandise for the value of 100. As a result, the company will need to use the contra asset account, the contra revenue account, sales returns and allowances, and they would also they need to credit accounts receivable in order to decrease it. So here the company debited sales returns and allowances, which is a contra revenue account, and at the same time they needed to decrease accounts receivable, so they credit accounts receivable $100. At this point, the customer owes the company $900 and not $1,000 anymore because they have returned $100. So on July 11th, Jordache receives payment from Polo Company for the balance due. As a result, the full amount is credited to accounts receivable, but because it was paid within the discount period, the company will have to debit cash $882 and sales discounts the 2% multiplied by 900. Remember, the 2% is multiplied by the 900, which is 1,000 minus the returns. Now, some retailers, they issue their own credit cards. Here, for example, let's talk about JCPenney. If JCPenney issued their own credit card and the customer uses it to purchase some merchandise for the value of $300, the company at this point will recognize this as sales on account. As a result, they will debit, the JCPenney will debit accounts receivable $300 and credit sales revenue $300. Now, assuming that you owe $300 at the end of the month and JCPenney charges 1.5% per month on the balance due, JCPenney will need to make an adjusting entry if you still haven't paid the amount. And a lot of companies do that. They would give you, for example, a certain grace period within which, within that period, if you pay the full amount, you will not be charged any interest. But if you pay after that time, you will be charged a certain interest. In this case, for example, it is after 1 month, the company will be charging you 1.5%. At this point, if you still owe the money, that means you haven't paid JCPenney yet, but JCPenney has earned 1.5% of that amount in interest. As a result, they need to recognize that. So at that point, they will debit accounts receivable 1.5 times 300, which is 4.5. So this is 1.5 multiplied by 300, and they will credit interest revenue. What the company did now, they have recognized the interest that they have earned from the unpaid balance of $300. Now, the real problem with accounts receivable is not recognizing them. That's easy, as we can see. The main problem is valuing them. And here, the thing is that the companies will have to report this at the end of the year as a current asset, but there is a certain part of the accounts receivable that will not be collected. For example, there are certain customers, for example, might default. As a result, the company all companies, they always expect to have some kind of a part of these accounts that will not be collected, and those are usually those uncollectible amounts. The company does not know upfront which customers will default and which customers will actually pay. As a result, the company cannot say for sure that we know like 95% of these, for sure that 95% of the accounts receivable will be received. They can only estimate that. And the company will need to report on the balance sheet the net realizable value. And the net realizable value, this is the amount that the company actually expects to collect. It may not be exactly the amount that they would collect, but this is the amount that the company expects to collect based on previous history. And usually the amounts that are not collected, they are called bad debt expense, and sometimes it's called as uncollectible accounts expense. Companies, most companies, they have to conduct business on account in order to attract customers. But when the higher the amount of sales on accounts, the higher the risk of, or the higher the amount that is that might be uncollected. And this is why it is a very important thing to know how to value them in order to be faithfully representative, in order to be fairly representative of the actual amount, actual net realizable value or cash realizable value. Now, there are two main methods of accounting for those uncollectible accounts. We have the direct write-off method and the allowance method. Now, the direct write-off method, at this point, bad debt expense, it will only show the actual losses. So accounts receivable will be recorded at its gross amount. In other words, the company will be reporting accounts receivable as it is, it will not be reported at net realizable value, but at its gross amount, that were basically the balance. The main problem with this one is that it can get misleading, because at this point the company will be writing off any uncollected amount when that happens. So for example, let's say in 2014 the company makes a sale on account, and so at the end of the year the company will still keep that amount on the balance sheet. Say that it's $1,000 accounts receivable. But let's say that the customer in 2015, they fail to pay. One of the customers who has a value of, who has an account receivable of $300. At this point, the company will be simply writing off that $300 in 2015. The problem here is that it will not be matching, it will not actually match the revenues. So the revenue was made, the sales revenue was made in 2014, but the writing off, and which is the bad debt expense, so the bad debt expense was recognized in 2015, which violates the matching principle, where expenses which should follow the revenues. At this point, the revenue was recorded in 2014, but the expense was recorded in 2015. This is why this is not acceptable for financial reporting. On the other hand, the allowance method, it has a better matching of expenses and revenues. Here, the company would estimate the amount that will be uncollected. So the company will estimate the bad debt expense at the end of the accounting period, and which would enable the company to report the receivable at the cash realizable value. And this is the method that is required to be used by GAAP, except if the amount was really insignificant and immaterial. If the amount is material, the companies are required to use under GAAP, under US GAAP, the companies are required to use the allowance method. So let's see how the direct write-off method or the uncollectible accounts would work. For the uncollectible accounts works, and then we'll talk about the allowance method. First, let's assume that Warden Company writes off M.E. Doran's $200 balance as uncollectible on December 12th. Worden's entry will be a debit to bad debt expense and credit to accounts receivable. At this point, the company has simply written off the account, the account receivable that for the one that was that defaulted. But once again, there is no matching of bad debt expense and revenues. And here, for example, let's take another example and see what we really mean by the matching of bad debt expense and revenues. Let's assume that a certain computer company starts a promotion in 2014, where in December 2014, where the company would offer a laptop for anyone who wants to buy a laptop at a low interest and without any credit checks, without any requirements. So the company would just, like, if you want a laptop, just go pick up one and sign the paper. There's no real verifications of the credit worthiness of all the customers. As a result, most likely the customers would those computers would sell very fast, and the sales revenues of that company will increase tremendously. Now, let's say that in 2015, because the company did not take the necessary precautions necessary precautions to make sure that the customers will be able to pay back their debts, let's assume that 35% or 30% of the customers fail to pay back. At this point, the customers will be, let's say that those 30 customers under the direct write-off method, if they default, the company would simply write off those amounts in 2000 as bad debt expense in 2015, basically when they default. As a result, 2014's net income would be very high because they had no expenses, whereas the net income in 2015 will drop down dramatically because of the high bad debt expense, which was actually caused by which should be actually matched with the revenues from 2014. This is an example of where the direct write-off method would be highly misleading. On the other hand, the allowance method is done differently. In the allowance method, the company will estimate the amount of accounts receivable that will be uncollected. And this is usually done based on previous years. So the company would look at last year and see, okay, so this is the percentage or the part of accounts receivable or sales that was not collected last year. And then when they report accounts receivable at the end of the year, the company will basically use the contra asset account that is called allowance for doubtful accounts. So the company would, in order to recognize the expense, to match the expense with the revenue, the company would record the bad debt expense in the same accounting period at the end of the year to make sure that they match the expenses with the revenues. But because the company does not know exactly which accounts receivable defaulted, which customers defaulted on their payments, which accounts receivable will be uncollected, this information is not known in advance. But the company estimates that in general, we will have, for example, 5% of our receivables will be uncollected. So the company will credit allowance for doubtful accounts this amount to make sure that the expense has been recognized, but at the same time without attributing that to any specific accounts receivable. Later on, when the company writes off the uncollectible amounts, the uncollectible accounts receivable, they will, this is step 3 here, they will debit allowance for doubtful accounts to decrease to decrease it, and credit accounts receivable to decrease it. Basically here the company is lowering this doubtful account, because now they know which account has defaulted, and at that point they can actually write off that account. And this is the method that is required to be used under GAAP. So let's see how the allowance method works. Hampson Furniture has credit sales of $1,200,000 in 2014, of which $200,000 remains uncollected. So the uncollected amount at the end of the year is $200,000. So this is the balance in accounts receivable. So this is the balance in accounts receivable. The credit manager estimates that $12,000 of these sales will prove uncollectible. So the bad debt expense, the value of the bad debt expense is $12,000. Now this is, so far they are giving us the estimation. This is step one. So the first step, as you remember with the allowance method, the first step is to estimate the amount that will be uncollected. The second step is to recognize or to record the bad debt expense. And the third one is when it is actually written off, if the company decides to write it off. In this case, the estimation of uncollectible accounts is $12,000. So the company at the end of the year will debit bad debt expense $12,000 and credit allowance for doubtful accounts $12,000. This is the second step. This is where the company records the expense in order to match it with the revenues of this in the same year. And this is how it will look like on the balance sheet. This is a partial balance sheet. As you can see here, you have accounts receivable less allowance for doubtful accounts. And this is here, the amount here is the cash realizable value or net realizable value. This is actually the actual value of the account receivable. This is, as you can see, as you remember, this is a contra asset account. So this is a contra asset account. This is why it's listed right after accounts receivable, and the value of accounts receivable will be the gross amount, which is 200 minus the 12,000. And of course, accounts receivable and its contra asset and its contra account are listed under current assets. Now, when the company writes off or decides to write off a non-collectible account, this is when the company has lost all hope of collecting the money. So usually companies, for example, they contact the customer several times, they send them notes, etc. If they lose any hope of customers paying back, the company will write off the account. However, usually write-offs are only authorized by management. So only this is in order to control for the write-offs, because at this point you don't want excessive write-offs. And in this illustration, the Vice President of Finance of Hampson Furniture on March 1st, 2015, so this is in the following year, authorizes a write-off of the $500 balance owed by R.A. Ware. The entry to record the write-off is, at this point, the company decided to write off the account owed by R.A. Ware. Because the company knows which account defaulted, the company will debit allowance for doubtful accounts $500 and credit accounts receivable R.A. Ware $500, because at this point they know which account has defaulted. Now, as you can see here, the amounts here, if you add this one, if you subtract this one from this one, so if you have 199 500 minus 11 500, it will be 188,000. And if you subtract 12,000 from 200, it will also be 188. And this is to say that the cash realizable value of accounts receivable will remain the same before and after the write-off, because at this point we are decreasing, the journal entry will be decreasing both accounts. It will be decreasing accounts receivable by the amount that was written off, and it will also decrease allowance for doubtful accounts by the same amount. And as you can see, the write-off journal entry will only affect the balance sheet accounts because it's affecting allowance for doubtful accounts and accounts receivable, but not bad debt expense. So it will not affect income statement accounts. Usually the company would present the balance sheet like we said here. You have, for example, accounts receivable less allowance for doubtful accounts, and this is the cash realizable value or net realizable value. And there's another presentation that the company can use which conveys the same information, and this is where the company would say accounts receivable net of $25 allowance, and it shows it as again the cash realizable value. And here simply we know that there was a $25 allowance, so the actual balance of accounts receivable will be 500, and the allowance for doubtful accounts is 25. So now let's see how this company, how the company will keep on recording the changes to allowance for doubtful accounts and to accounts receivable. So those are the balances. Those were the balances from year one. Let's say that those were the balances beginning, which is to mean ending. Let's say that this one was for 2013. So here it was beginning, which is to mean this is beginning of 2014. As you can see, ending balances from 2013 will be beginning balances of 2014. So this is the beginning balance. We started off with a beginning balance of 525 allowance for doubtful accounts. This is the information that was here. So now the company made a credit sale. When the company makes a credit sale of 100, the company will debit accounts receivable 100 and credit sales revenue 100. At this point, we are only adding the changes to accounts receivable and allowance for doubtful accounts, and simply because basically the screen doesn't fit more than those accounts. But if we were to add the whole thing, we would also need to add here sales revenue. It was credited 100. Remember that the beginning balance of revenue will be 0 because revenues are temporary accounts and they will be closed at the end of the accounting period. So at this point, the company will debit accounts receivable 100. And let's say that the company collected $333 on account. So they collected cash. As a result, they will debit cash 333 and will credit accounts receivable 333 because they collected money that customers owed. As a result, their accounts receivable decreased. So we credit accounts receivable $333. The company, let's say that the company estimates bad debts to be $15. So they debit bad debt expense $15 and they credit allowance for doubtful accounts $15, and it will be entered on the credit side of allowance for doubtful accounts. If the company writes off uncollectible accounts for $10, remember, whenever the company writes off an account, the company will debit accounts receivable and credit, they will debit allowance for doubtful accounts and credit allowance receivable. They will debit allowance for doubtful accounts $10 to decrease it and credit accounts receivable $10 to decrease it. Remember, allowance for doubtful accounts is a contra asset account. As a result, the normal balance is a credit balance. So a debit to allowance for doubtful accounts will decrease the balance. So this is why here we had 40. After the write-off, it became 30. As a result, the company will, at the end of 2014, so this is at the end of 2014, they will list accounts receivable a net of $30 as they will report accounts receivable at a cash realizable value of 227, and this is basically the 257 minus 30. So it will be net of $30 allowance, it's 227, which is 257 minus $30. This is the recording of the accounts receivable and the allowance for doubtful accounts. Now, in certain cases, the customer might come back and pay the amount that was already written off. So it's not like all the customers who default on a certain payment, they do it on purpose and they decide not to pay anymore. In many cases, the customers, they're simply, maybe for example, they had some unexpected payments, like hospital surgical operation or something like that, or they had a lot of sudden payments that they did not anticipate. As a result, they were not able to pay their debts. In this case, they might, once they have money, they might contact the company back and tell them that, okay, now that I have more money, I can pay them, I can pay my debt. Let's say that also, or in certain cases, the customer might simply lose their job. If they lost their job, what will happen is maybe they don't have any more money to pay their debts, and this was what happened for a lot of homeowners, where they defaulted on the payment of their mortgages. It's not that they didn't want to pay, it's simply they didn't have the means to do that. So let's say that a certain customer loses their job. If they lose their job, they might default on the payment. After a certain period of time, the company might write off that account. Let's say like several months later, the customer actually gets another job and starts paying back their debts. And so let's assume that this was here the scenario. At this point, the company will be receiving a check from that customer, say R.A. Ware, whose account was written off on March 1st. So how does the company make the journal entry? The company cannot directly accept the cash, because as far as the company is concerned, they have written off the account, so the account receivable for that customer. So as a result, first thing they need to do is to re-establish that account receivable. And the way to re-establish that account receivable is by writing the reversal of is basically by reversing the write-off journal entry. As a result, they would debit account receivable for that account and credit allowance for doubtful accounts. And this way, they have re-established the account receivable. They have re-established the account, and then because they have received cash, they debit cash 500, and at this point, it's as if the customer has paid back their debt before, and then the company would credit account receivable 500. As you can see here, the overall change to account receivable is 0, because we debited account receivable 500 and credited account receivable 500. As a result, the change is 0. So far, we have been using the information given to us as far as estimation goes. but the companies, they usually estimate, they need to estimate the bad debts, and they usually have one of two ways to estimate this allowance. They either use percentage of sales or percentage of receivables. Percentage of sales is simply saying that, for example, the bad debt expense will be 5% or let's say 2% of the net credit sales. On the other hand, and this is, as you can see, it focuses on the matching of expenses with the revenues. So here the emphasis is on the income statement accounts. On the other hand, companies can also use the cash, can emphasize on the balance sheet accounts, and at this point they look at the cash realizable value. Here the idea is to say that based on previous history, 5% of all the accounts of the balance in the accounts receivable at the end of the year will be uncollected, and as a result the allowance for doubtful accounts will be 5% of the accounts receivable. Both methods are allowed and are acceptable under US GAAP, and companies can choose which one, basically can choose either one based on their own judgment. So let's see how each one, every one of them will work. Okay, so as we can see here, so for the percentage of sales, the company can estimate or predict future amounts that will be uncollected based on previous year's information. Here, for example, this is an illustration of the percentage of sales method. Assume that Gonzalez company elects to use the percentage of sales basis. It concludes that 1% of net credit sales will become uncollectible. So if net credit sales for 2014 are 800,000, the adjusting entry at the end of the year will have to be, it will be 1%, so it's 1% multiplied by 800,000, and this is 8,000. So the amount is 8,000. How does the company record this information under the allowance method? The company will debit bad debt expense 8,000 and credit allowance for doubtful accounts 8,000. Here, the reason why we're talking about net credit sales is that cash sales are not involved at all because the cash is collected automatically. But so we are only interested in the sales that were made on account. So credit sales are sales on account, which will affect the accounts receivable balance. Here, like we said, the emphasis is to match expenses and revenues. And as we can see, the adjusting entry here, this is the adjusting entry. So, and we will see in a second why this is important. So this is the adjusting amount. It will be the percentage. This is the estimated uncollectible rate multiplied by the net credit sales. So this is the adjusting amount. So when you use percentage of sales, when a company uses percentage of sales, in order to get to the ending balance in allowance for doubtful accounts, they will have to take into consideration it will have to add the previous balance and allowance for doubtful accounts. But when the company is what the company is actually calculating using the percentage and the net credit sales is actually the adjustment for bad debt expense and for allowance for doubtful accounts. The other method is called aging the accounts receivable. This is basically using the percentage of receivables, and the idea here is that based on last year and the years before, the company will first group or categorize they will categorize the accounts receivable based on the length that the account has not been paid yet. So the longer past the due date, the more likely it is to be uncollectible. So this is based on previous experience with regards to each section, each category. So here, for example, those are the accounts that are not due yet. And based on previous years, 2% of all the accounts that are not yet due will eventually default and will be uncollectible. And then we have here the numbers of days past due date. So if it is within 1 month of the due date, it according to this company. Now remember, this is not for all the companies. These numbers will depend on every company and its history. So as far as this company is concerned, accounts receivable that are within 1 month past the due date, the company estimates that 4% of this amount will be uncollectible. If it is 1 to 2 months, it will be 10%, 2 to 3 months, 20%, and over 90 months, it will be 40%. And the idea here is that the longer the account is past due date, the more likely that the customer is really having trouble paying it back or does not want to pay it back. And as a result, the probability that this account will be eventually uncollectible increases. And here what the company does, we multiply 40% multiplied by this amount, and this will give us 760. And we multiply 2000 by 20%, and this will give us 400. Once we calculate all these amounts, we have all these amounts, we add them up, and that would give us the 2228. And here what we are saying is that the total estimated bad debts is 2228. This is the ending balance. This is the ending balance of allowance for doubtful accounts. This is not the adjustment. This is the adjusted balance. So this is the required balance in allowance for doubtful accounts. Let's look at this example here. Assume the unadjusted trial balance shows allowance for doubtful accounts with a credit balance of 528. Prepare the adjusting entry assuming 2228 is the estimate of uncollectible receivables for the aging schedule. So this is this amount here. We assume that this amount is the uncollectible. As a result, this is an illustration of the aging method or the percentage of receivables method. Assume the unadjusted trial balance shows allowance for doubtful accounts with a credit balance of 528. Prepare the adjusting entry assuming 2228 is the estimate of uncollectible receivables from the aging schedule. Remember, when we use the percentage of receivables, this amount here that shows here, this would be the ending balance. That's the required balance, where this is the beginning balance or unadjusted balance, and we need to get the adjustment. So the first thing to do is we need to calculate that. So we have allowance for doubtful accounts. Original balance was 528, and the ending balance will have to be 2228. And we need to calculate the adjustment. So here the adjustment is equal to, basically we have 528 plus adjustment is equal to 2228. As a result, adjustment is equal to 2228 minus 528, and that is equal to 1700. So the company at this point would debit bad debt expense 1700 and credit allowance for doubtful accounts $1700, and this is the amount here. It's the adjustment, whereas the amount here, the 2228, is the ending balance. So this is the ending balance. It is 2,228, and the 1,700 is the adjustments. As we can see, the usage of the percentage of receivables method would emphasize the cash realizable value here, and it would also give us, the amount that will be estimated will be the required balance. So in order to get to the adjustment, we will have to add, we'll have to take the beginning balance of allowance for doubtful accounts into consideration. Now, in certain cases, the company might have an original, basically an unadjusted balance that would be a debit balance. So if they have a debit balance before the adjustment, this would happen when the write-offs during a year exceed previous provisions for bad debts. Basically, if the actual write-offs were more than the allowance for doubtful accounts, the beginning balance, at that point, the unadjusted balance before adjustment, basically, we would have a $500, it would have a debit balance rather than credit balance. Although allowance for doubtful accounts is a contra asset account, which is to mean it has a normal credit balance, still sometimes it might have a debit balance if the write-offs were more than the previous provisions for bad debts. This is another example here. Brule Company has been in business 5 years. The ledger at the end of the current year shows accounts receivable 30,000 debit, sales revenue 180,000 credit, and allowance for doubtful accounts 2,000 debit. So bad debts are estimated to be 10% of receivables. Prepare the entry to adjust allowance for doubtful accounts. When we have a question like that, it is best to use the T account. At this point, they are asking us for the adjustment for allowance for doubtful accounts. So allowance for doubtful accounts. The beginning balance was 2,000 on the debit side, so it was 2,000 on the debit side. The ending balance will have to be 10% of receivables, and 10% of receivables is equal to 3,000, so 10% multiplied by 30,000 is 3,000. Here we need to calculate the adjustment. So at this point, the adjustment, we have minus 2,000, this is the credit here, plus adjustment is equal to 3,000. As a result, the adjustment will have to be a credit of 5,000. And as a result, the company would debit bad debt expense 5,000 and would credit allowance for doubtful accounts 5,000. Here we said minus 2,000 because it was the beginning balance was a debit of balance of 2,000, and allowance for doubtful accounts is a credit, has a normal credit balance. So this is an example of a question that might be asked on the exam. Net sales for the month are 800,000, and bad debts are expected to be 1.5% of net sales. The company uses the percentage of sales basis. If the allowance for doubtful accounts has a credit balance of 15,000 before adjustment, what is the balance after adjustment? So what they are asking for is the balance after adjustment. This is the ending balance. We know that the net sales here, the assumption is that those are credit sales. Okay, so those are credit sales. It's 80,000, and we are using here the percentage of sales. Once again, let's use the T account. allowance for doubtful accounts. The beginning balance of allowance for doubtful accounts was 15,000 credit, and then the adjustment will be equal to, here the adjustment will be equal to 1.5% multiplied by 800,000, and this is equal to 12,000. This is the adjustment. So the adjustment is 12,000 credit, and the ending balance will be here 27,000. So the correct answer is D. And here, if we wanted to write the adjusting entry for to record the bad debt, the company would debit bad debt expense 12,000 and credit allowance for doubtful accounts 12,000. And this is another question. In 2012, the Dugan company had net credit sales of 375,000. On January 1st, 2012, allowance for doubtful accounts had a credit balance of 8,000. So this is the beginning balance, and net credit sales was 375. During 2012, 15,000 of uncollectible accounts receivable were written off. So we had 15,000 written off. Past experience indicates that the allowance should be 10% of the balance in receivables. So here we are using the percentage of receivables. If the accounts receivable balance at December 31st was 100,000, what is the required adjustment to the allowance for doubtful accounts? So we need to get the adjustments. And the accounts receivable balance at the end of the year was 100,000. Here, this information here will not be used at all. We don't need the net credit sales. We know that the ending balance for, again, let's use the T account, allowance for doubtful accounts. It had a beginning balance of 8,000. The ending balance will have to be, it's 10% multiplied by 100,000, which is the account receivable balance, and this is 10,000. As a result, we know that the ending balance will have to be 10,000. There were also 15,000 here that were written off. When you write off an account, when we write off an account, we debit allowance for doubtful accounts. So we have a debit of 15,000, and we have here the adjustment. So here we have 8,000 minus 15,000 plus the adjustment must be equal to 10,000. As a result, we have the adjustment is equal to 10,000 plus 15 minus 8, which is equal to 17,000. And this is the correct answer here. Putnam Company's account balances at December 31st for accounts receivable and allowance for doubtful accounts were 1,400,000 and 70,000 credit respectively. An aging of accounts receivable indicated that 108,000 are expected to become uncollectible. The amount of the adjusting entry for bad debts at December 31st is. Once again, when we have a question like that, first we need to look at what they are asking for. They are asking for the adjusting entry. Then we look at what method they are using. Here, they are using an aging of accounts receivable. So they are using the percentage of receivable method, and the estimated amount is 108,000. That would be the ending balance. So here they are asking for the adjusting entry for bad debts. As a result, once again, we look at allowance for doubtful accounts. Original balance was 70,000 credit. The aging said that the aging schedule would give us 108,000 are expected to be uncollectible. The adjustment here in this case will simply be 70,000 plus adjustment equals to the ending balance. So the adjustment will be value will be equal to 38,000. So the answer would be B. During 2012, Hitchcock Inc. had sales on account of 132,000, cash sales of 54,000, collections on account of 84,000. In addition, they collected 1,450, which had been written off as uncollectible in 2011. As a result of these transactions, the balance in the accounts receivable is. So here they are asking us to calculate the balance in accounts receivable. We start with first again with the T account. So account receivable was the company had sales on account 132. So we had a debit of 132,000. Cash sales, we don't include them. Collection on account 84. Those were credits to accounts receivable. In addition, they collected 1,450, which had been written off as uncollectible. Collection of a written off account will be a debit of 1,450 and a credit of 1,450. As you remember, we will first debit the account to reestablish the account that was written off, and then we credit it because we had debited cash. This was when the company had basically collected the cash, and here we have 132,000 plus 1,450 minus 84,000 minus 1,450. Those two will cancel each other out. As a result, the balance in account receivable will be 48,000. So the answer would be C. A company has net credit sales of 700,000 for the year, and it estimates that uncollectible accounts will be 2% of sales. If allowance for doubtful accounts has a credit balance of 1,000 prior to adjustment, its balance after adjustment will be a credit of. Once again, we look at here we have it's the percentage of sale. The company is using the percentage of sales. Oops. A company has net credit sales of 700,000 for the year, and it estimates that uncollectible accounts will be 2% of sales. So here we are using percentage of sales, and the net credit sales was 700,000. If allowance for doubtful accounts has a credit balance of 1,000 prior to adjustment, its balance after adjustment would be a credit of. So Here again, we use T account, allowance for doubtful account. It originally had 1,000. And remember, the percentage of sales will give you the adjustment itself, not the adjusted balance. So the adjustment here will be 2% multiplied by 700,000. It will be 14,000. So here the adjustment is 14,000, and as a result, the ending balance will be 15,000 credit, and the answer will be here A. Now, the third part that we need to be concerned about with regards to accounts receivable is disposing of accounts receivable. And companies, basically, this is selling the accounts receivable, and companies might do that, for example, when they need to raise some cash, and it will be the only source of cash, or if the collecting and billing, etc., become too cumbersome for the company to deal with, if it is too time consuming and costly, companies might sell this to other organizations who might have a dedicated collection department and people with expertise who are whose main job is to follow up with the accounts receivable and to collect them. So it could be, for example, to either raise some cash or to more or less outsource the collection of accounts receivable. And there are two ways of selling the receivables. The first one is called factoring, and here the company what the company will do is they will the company would sell their existing receivables to another organization who will be charging them a certain fee in order to they will charge them a certain fee for the collection of the receivables. So the customer will be paying the full amount to the factor. The factor will pay the retailer. So the retailer will be getting from the factor full amount minus the charge, and the factor will be left off with the charge, with the amount of the charge. But the retailer won't have to wait for the factor to collect the money from the customer. Basically, they would once they sell it to the factor, they will collect the cash, and later on the factor will be following this up with the customer. So let's see how this is entered. Assume that Henderson Furniture factors 600,000 of receivables to Federal Factors. Federal Factors assesses a service charge of 2% of the amount of receivables sold. The journal entry to record the sale by Henderson Furniture is as follows. This is where here we mean the sale of receivables. The charge will be of 12,000 because it is 2% of 600,000. So as far as the company, as Henderson Furniture is concerned, they will receive 600,000 minus the fee. So it will be 588. So this is basically 600,000 minus the 12,000 fee. So the company will debit, the journal entry will include a debit to cash by 588,000, and then service charge expense 12,000, and accounts receivable 600,000. So every time that the company factors accounts receivable, they will debit cash, the amount minus service charge. Then they will debit the service charge expense and credit accounts receivable, the full amount. Another way of disposing of accounts receivable is when companies they conduct a business on credit card sales. So when they conduct business using credit cards, this is not their own credit card like we mentioned with the JCPenney example. This is national credit cards, like for example, a credit card from a bank, a Visa card from a bank, or a MasterCard from a bank. So here, the retailer, the company will record it as a cash sale. The amount of that cash sale will be the full amount minus the charge. Here, once again, the retailer will get directly cash full amount minus charge, because the credit card issuer will charge the retailer a fee between 2 to 6%, and this is depending on the agreement. This is for processing the transaction. The customer and the credit card issuer will later on collect the money, the full amount, from the customer. Let's see how this is done. Anita Ferreri purchases $1,000 of compact discs for her restaurant from Karen Kerr Music Company using her Visa First Bank card. First Bank charges a service fee of 3%. The entry to record this transaction by Karen Kerr Music is as follows. Once again, Anita will record this transaction as a cash transaction. So it will be cash, but for the amount of 1,000 minus 3%, which is 30. So the fee will be 3% multiplied by 1,000 is equal to $30. As a result, Anita Ferreri will debit cash 970. Anita Ferreri will also debit Karen Kerr Music. So this is the retailer. This is the retailer. This is the retailer. This is the customer. The bank will charge, in this case, the bank will charge the retailer. The bank does not charge the customer. So Karen Kerr Music will make the following journal entry: a debit to cash for 970, a debit to service charge expense 30, and then the credit is sales revenue. Here, the company is not selling an existing accounts receivable. So in contrast with the factoring we had credited accounts receivable, but the company here is considering this transaction as a cash sales. This is why it's recognizing the sales revenue at this point. ABC Company accepted a national credit card for $5,000 purchase. The cost of the goods sold is $4,000. The credit card company charges a 3% fee. What is the impact of this transaction on net operating income? So here, when we say that the ABC Company accepted a national credit card for a $5,000 purchase, it means that the company has made a credit card sale for the value of $5,000 as a result. So this will be a sales revenue. So the sales revenue will be, so the 5,000 will increase net income. So there will be plus 5,000. The cost of goods sold will decrease net income by 4,000. And then there is also the charge, the expense that the company will, that the credit card issuer will charge the company, which is 3%. And here again, 3% multiplied by 5,000 is 150. So there's also a decrease by 150 to net income. Remember that what affects the net income will be revenues and expenses. So as a result, the overall change in operating income will be 850, and that would be 5,000 minus 4,000 minus. So it's 5,000 minus 4,000 minus 150. That would be an increase by 850. Now we get to notes receivable. So note receivable is basically a promissory note. This is a formal document where the customer promises to pay a certain amount at basically either on demand or at a definite time. And because it is it has a formal proof, it has a stronger claim on the assets of the customer than accounts receivable. And usually promissory notes can be used when customers are borrowing money or lending money. It would be at this point when the lender will have a note receivable, whereas the borrower will have it will be to the borrower it will be notes payable. And in other cases, the company might also resort to promissory notes when the amount of the transaction is high or when the credit period is very long. And third, it can also be used when customers they don't have a good credit history, and as a result, the company might request a formal promissory note. In certain cases, also when a customer defaults on a payment of accounts receivable, they might make a deal with a company in order to by using this promissory note to settle their accounts. And this is how the promissory note looks like. The customer who is making the promise to pay is called the maker, and this is the party that is issuing the note, the promissory note, and to the maker it will be considered as note payable because they promise to pay. To the company who will be receiving the money, it will be a note receivable, and that the company is called the payee. And the note receivable, the promissory note, basically it has information such as the amount, the due date, the payee, the maker. It has the interest rate because, as you remember, notes receivable they incur interest, and it also has the date, etc. Now, notes receivable are paid the full amount, and the interest they are all paid at maturity date. So usually maturity date is expressed either in months or days, and this slide here it simply explains how to calculate them. Basically, if it is based on days, you have to calculate the day to calculate days exactly to know when the note receivable will mature. The interest is always the same. You multiply the face value of the note. Face value is the original amount. That was the amount that was borrowed, or that was the amount that was mentioned on the note receivable, on the promissory note. And then you multiply that by the annual interest rate and by the time in terms of years. So if we are talking in terms of months, if the note receivable says, for example, here 6 months, you multiply it by 6/12. If it is 120 days, you divide 120 days by 360, etc. And this is how we calculate the interest. We always multiply the face value times the annual interest rate times the time and multiplied by the time in terms of years. So this is an example of how this is calculated. Calhoun Company wrote a 1,002-month 12% promissory note dated May 1st to settle an open account. Prepare the journal entry Wilma Company makes for the receipt of the note. So this is the maker, because they issued or they wrote the promise, they made the promise, and this is the payee. It is 1 month, it is 1,000, this is the face value, 2 months, 12%. Again, whenever you are given an interest rate, this is always an annual interest rate. And this is to settle an open account. So the maker, Calhoun Company, is not borrowing money, but they are settling an open account, which is account receivable. As a result, the company will make the on the day it is signed, the company, Wilmar company, which is the payee, will debit notes receivable 1,000 and credit accounts receivable 1,000. Because at this point, Wilmar company has not started earning any interest yet, and they do not get cash because and they did not get cash, or they did not pay in cash, because so far the note receivable is to settle an open account. The interest will start accruing. However, it will not be paid until maturity date. That was for recognizing note receivable. So, actually, note receivable, when we deal with note receivable, we also need to worry about, or we are concerned with, we need to consider the three same issues, which is recognizing or recording a note receivable, valuing note receivable, and disposing of note receivable. In the previous slide, we saw how we record note receivable if it were for cash. So for example, here, it was to settle an account, so we debited note receivable and we credit accounts receivable. If the company, if Calhoun company, which is the maker, was borrowing money, Wilmar company, who is the payee, would have debited note receivable and credited cash. So this is how we recognize note receivable. As far as valuing notes receivable, again, they are also reported as short-term notes. So short-term notes receivable, which are due within 1 year, they are reported under the current assets at their cash realizable value. So they are the estimate, and here also we use the allowance method. So we use the allowance for doubtful accounts, and the estimation is done in the same way as we did for accounts receivable. Disposing of notes receivable is slightly different. Here, the notes receivable, there are three scenarios. First scenario is when the maker of the note receivable honors the note receivable at maturity date. So this is when the company keeps the note receivable until maturity. This is called held to maturity date. At that point, the company will be, the payee or the company will be receiving the face value plus any accrued interest. So the payment, the full payment, will be equal to the face value plus accrued interest. The second scenario is where the holder tries to, for example, the company, they might also negotiate and sell. They might negotiate and sell the note receivable to a third party. The third scenario is where the maker of the note receivable defaults on the payment. At that point, the payee will have to make an adjustment to their books. And we will look at the first and third scenario. The second scenario, we will do that in future chapters when we talk about notes payable. Now, like we said, there is either honoring the notes receivable or dishonoring the notes receivable. If the maker honors the note receivable, the maker will pay on maturity date the face value plus interest. If they dishonor the note receivable, then basically they will not pay anything at maturity, and at that point the note receivable becomes non-negotiable because the company will not be able to sell it to someone else. Let's see how we make the journal entries to record the honoring and dishonoring of notes receivable. So Walder Company lends Higley Company $10,000 on June 1st, accepting a 5-month 9% interest note. If Walder presents the note to Higley Company on November 1st, the maturity date, Walder's entry to record the collection will be, first of all, this is the payee, and Higley Company is the maker. The amount face value is 10,000 on June 1st, accepting a 5-month 9% interest rate. Now, on November 1st, the maturity date, this is the maturity date, Walder Company will be receiving full amount, which is face value plus interest. At this point, we need to calculate the interest. So the interest amount will be equal to the face value multiplied by interest rate multiplied by terms in years. So here it will be 10,000 multiplied by 9% multiplied by 5 months, 5/12. And this amount is $375. So the interest is $375. As a result, on maturity date, November 1st, the company will debit, because they will receive cash, full amount, which is face value plus interest. It is 10,000 plus 375, and the company will debit cash 10,375. It will credit notes receivable 10,000, and the remaining 375, this is interest revenue. It will recognize it as interest revenue. So this is the interest, this one is the note receivable, and this is cash. Now, notes receivable, whenever you are disposing of note receivable, the amount will always be the face value. So this is the face value. Face value. It's always face value. When you credit notes receivable, you will be crediting the amount of the face value. Now, suppose instead that Walder Company prepares financial statements as of September 30th. The adjusting entry by Walder is for 4 months ending September 30th. So this is where the company closes their books, prepared financial statements, and this is maturity date. This is maturity date. Remember, notes receivable will only be paid on maturity date. So on this day, the company will not receive any cash. Instead, however, they did earn 4 months worth of interest. So they have accrued interest for 4 months. As a result, the company will need to make an adjusting entry to recognize the interest revenue that was earned in these 4 months. But because the maker will not pay at this point, the company will debit interest receivable 300 and will credit interest revenue 300. This is to recognize the accrued interest, and by this to adjust for the accrued interest and to recognize the interest revenue for the 4 months. Now on the 1st of November, when Walder presents the notes receivable to Higley, they will debit cash 10,375. This is again, they receive face value plus interest, face value plus interest. They will also credit note receivable 10,000. The company will recognize will also credit interest receivable. This is to decrease the interest that was not that was accrued but was not paid up to end of September 30th, and the company will also credit interest revenue 75. This is for the interest in October. This is the note receivable this is the face value, and this one was for the 4 months before September 30th. Now let's say that the maker dishonors the note receivable. If the company, so assume that Higley Company on November 1st indicates that it cannot pay at the present time. If Walder Company does expect eventual collection, let's say that Higley told them that, okay, I will pay you in few months or something like that, it would make the following entry at the time the note is dishonored. And this is assuming there was no previous accrual of an interest. So the company at this point will debit accounts receivable the full amount because they did not receive cash. So this cash becomes an account receivable that the company expects to receive. And and Walder Company will also credit note receivable 10,000. Remember, it's always face value, and it will also credit interest revenue 375. So basically, the company recognized the interest revenue. They also credited note receivable, but because they did not receive cash, but they still expect payment from Higley Company, they debited account receivable the amount. If, on the other hand, Walder's Company, they lose any hope of collecting the money, they will simply write off the account by debiting allowance for doubtful accounts and crediting notes receivable. As you can see in this case, they will not recognize no interest revenue will be recorded because the account was written off completely. As far as the presentation on the financial statements, on the balance sheet, on the balance sheet or in the notes, the company must basically disclose and identify the types of receivables that they have. And usually short-term receivables are reported as current assets right after short-term investments. And we also have the receivables are usually reported at gross amount. So you have the gross amount for accounts receivable and notes receivable, but also you have allowance for doubtful accounts right after that. Or as you can remember from before, you can also have accounts receivable net of allowance such and such. Now, on the other hand, on the income statement, the company would report bad debt expense and service charges from the service charge expenses as selling expenses. In other words, those are on the multi-step income statement, those are under operating expenses. And interest revenue is usually reported under other revenues and gains, especially if it is a merchandiser company. Because this is a revenue that the company is earning, but it is not the main line of business. Once again, it is important to analyze the information that accounts receivable balances and allowance for doubtful accounts, basically the bad debts and uncollectibles, what kind of information they can give us. So companies, they use accounts receivable turnover in order to assess the liquidity of the receivables. Here this ratio, the accounts receivable turnover ratio, it measures the number of times that the company collects accounts receivable during a certain during the accounting period. On average, of course, it's on average. So basically, it looks at on average how many times during that year the company was able to collect their accounts receivable. And we calculate that by dividing net credit sales. Again, we don't include cash sales because those were collected immediately. So we have net credit sales is divided by, so net credit sales divided by the average net accounts receivable. So in this case, we have in 2009, Cisco Systems had net sales of 32,420 million for the year. Beginning accounts receivable was 3,177. Ending accounts receivable was 4,929 million. if here the assumption is that all sales were on credit, basically those are net sales, how do we calculate the accounts receivable turnover ratio? We divide the net credit sale by the average from these two. And how do you calculate the average? We have the beginning balance plus the ending balance over 2. So here we have 3,000. This is the beginning balance plus the ending balance of net account receivable. This is the net balance of accounts receivable, and we divide it by 2. That would give us 8 times. Here what we are saying is that the company Cisco was able to collect their accounts receivable 8 times during that year, and usually the higher the ratio, the more liquid accounts receivable are, which is to mean the faster the company is at collecting their accounts receivable. And in certain and sometimes the companies also prefer to also decide to look at the average collection period in days, and this ratio tells us how long, basically how many days it takes a company to collect their accounts receivable. And we do that by dividing 365 by the accounts receivable turnover. So in this case, that was 365 days divided by 8 times, and that would give us 46 days, which is to mean it takes Cisco 46 days on average to collect their accounts receivable. And this ratio here, the average collection period in days, it gives us basically it tells us how efficient and effective is the credit collection of the company. So basically whether the company have good collection policies and good credit policies in general. On February 1st, Plaid Company received a 5,000 10% 4-month note receivable. The cash to be received by Plaid Company when the note becomes due is, once again, on maturity date, the company expects to receive the face value plus interest. Here, the face value is 5,000, so it is 5,000 plus interest, which is 5,000 multiplied by 10% multiplied by 4 over 12. So the 4 over 12 is because it is a 4-month, and as you remember, it is always an annual rate. So here it is 5,000 plus 167, which is equal to 5,167. That would be the amount that the company will expects to or will be receiving on maturity date if the maker of the note receivable honors that note receivable. Rogers Company lends Lanier Company 40,000 on April 1st, accepting a 4-month 9% interest note. Rogers Company prepares financial statements on April 30th. What adjusting entry should be made before the financial statements can be prepared? So here we need to recognize the accrued interest. We need to record the accrued interest. The face value is 4,000. It was signed on April 1st. It's a 4-month 9% interest. We need to make the adjusting entry for April 30th. So this is only 1 month. Don't look only at the month. We should look also at the day where we are making the journal entry, not just the terms of the note receivable. So the amount of interest revenue that we need to adjust for will be 40,000 multiplied by 9% multiplied by 1 month, because it is at the end of April, so it was 1 month, 1 over 12. As a result, this will be equal to $300. Now, when we recognize accrued interest, the journal entry is to debit, because remember, on this date the company will not receive any cash. The cash will be received on the maturity date only. As a result, the company will debit interest receivable and will credit interest revenue. So this is the answer. In 2012, Drew Gooden Company has net credit sales of 1,600,000 for the year. It had a beginning accounts receivable net balance of 101,000 and an ending balance of 107,000. To compute the accounts receivable turnover ratio, how do we calculate that? We need to divide the net credit sales by the average. So it is net credit sales is divided by the average net account receivable. So it is 1,600,000 divided by the average, which is 101 plus 107,000 divided by 2. And this is 15.4 times. And to compute Drew the average collection period in days, we divide 365 by 15.4, which was the turnover, the accounts receivable turnover ratio, and that would be 23.7 days, which is, and this tells us that the company was able to collect their accounts receivable 15.4 times during that year, and it takes them on average 23.7 days to collect their accounts receivable. That concludes our chapter on receivables, and we have discussed accounts receivable and notes receivable. We also discussed how to recognize value and dispose of these receivables.